Perfect. Thank you very much, Matthias. Thank you, Mario, for the invitation to speak at the IIF. My name is Jan-Philipp Weitz. I'm the CEO of Deutsche Rohstoff AG. Many of you may be familiar with the company, and some may not be. So I will try to touch on all elements of what we do, on our financial strength and the outlook for the company here over the coming years. So Deutsche Rohstoff is a company based in Germany and listed in Germany. We're listed on the Frankfurt Stock Exchange in the scale segment, and we're focused on oil and gas production in the United States, which is our key business and the core of our business. Historically, we've also been involved in the metals and mining space, and therefore all these things that some previous companies have talked about, like preliminary economic assessments and PFS, etc., are something that we are familiar with. But as of today, oil and gas is the core of our business. Roughly 10% of our 400 million euro balance sheet still represents the metals and mining space, but our revenue is 100% generated from oil and gas. And we are focused on oil and gas production in the US. That means, we have a variety of subsidiaries that we are producing oil and gas with in 3 different states. And in the first half of this year, we were able to produce around 10,500 BOE of production. That is oil and gas. So BOE stands for barrel of oil equivalent, which is a number that is certainly significant. It will lead to us, reaching a revenue of way north of 160 million euros this year. And we are targeting currently an EBITDA of 138 to 148 million euros, which you can see at the bottom here. And all of that with a market cap of 150 million euros. So our market cap is only, 10 to 15 million euros higher than our annual EBITDA. I think our 2022 numbers have already shown that with 66 million euros of net income, we have shown that we are, capable of being extremely profitable. And we have over the past years shown a very significant growth, which I will get into here in the coming slides, and also obviously show you the outlook for the next years. In terms of our capital market presence, I think what's important to mention is that we are a long-time listed company in Germany since 2010. Our share price is currently trading around 30 euros, which is representative of the 150 million euro market cap. And we have roughly 2 to 3 weeks back issued a 100 million euro bond at 7.5% coupon. I think that's also noteworthy because we were able to issue that bond, which was oversubscribed, and we actually unfortunately had to haircut some of the subscribers here, but I think it's also a big sign of the trust and the confidence of the capital market in our ability to execute our business plan. And 7.5% coupon for an oil and gas company certainly is a coupon that is attractive. I mean, for bondholders, but also from a company standpoint, we feel it's a competitive pricing, and we're very happy to see the strong demand here for our product. So what do we actually do? We produce oil and gas in the US, as I have mentioned. We do that in 3 states, mainly in the US. Those are Wyoming, Colorado, and Utah. We have 4 subsidiaries. They're all based in Colorado, with their head office. And from there out are operating in these 3 different states. And, while we started in the US oil and gas space about 10 years ago, we have in the meantime, grown into a relatively significant operator, with 4 different companies. Some of them drill their own wells. Some of them do not operate wells, but are a non-operator. But overall, we're producing from 300 oil and gas wells. So a very broad and very distributed production profile across many, many oil wells and many, many well bores, which, diversifies our production, which also leads to the fact that we have achieved to have a very stable production, as you can see on the right-hand side here, coming from, around 4,000 barrel of oil, equivalent per day in 2019 and 2020. We have recently grown into a range where this year we're guiding to produce 11,000 to 12,000, BOE per year, and next year it's going to be even more. And you can also see that in our growth here on the EBITDA side, which is going to reach, more than 150 million euros of EBITDA, very likely in 2024. And that's at a guided price for oil at $75. So today we're obviously at a very significantly higher oil price. Why we are in the US is something that has historically grown. I mean, we're obviously based here in Germany. We started out in the US in 2011 on the oil and gas side, and we have been very happy and thankful to be in the US. It's the #1 regulatory place for oil and gas operations. It's a very, very competitive market that does allow us to work very efficiently, to work with a lot of service companies, to work with a lot of partners here, and also to enter into some joint ventures that I will touch on later on to efficiently, develop our oil and gas resources here. So if you look at where we've come from and where we are headed, just on the revenue and the commercial financial side, in 2021 our revenue was still 73 million euros, and we were able to generate 66 million of EBITDA. In 2023 now, we are getting very close to the 200 million euro revenue mark. That's at a guided, $85 oil price here in the fourth quarter of this year. And in 2024, it looks like, even at $75 oil, we will be able to meet potentially the 200 million euro revenue mark. So I think from a financial standpoint, extremely strong financials. EBITDA margins obviously are extremely high in the oil and gas space. That is something to point out. But it's also important to point out that in order to achieve these EBITDA margins, in order to achieve these revenue volumes, and the growth that we have been showing here, it is necessary to invest a lot. And you can see that here in the third bar on this slide, CapEx. We have invested significant amount of capital last year. This year is a very big investment year for us. We have formed a joint venture mid last year with Occidental Petroleum, or better known as Oxy, a US oil and gas company. Very large. Warren Buffett currently is a very active shareholder there, and in the aftermath of COVID, they were looking for partners to develop some of the resources. So that's a very large joint venture in which we are investing in total $150 million. At the same time, we have our own acreage in our own area in the US that we are developing. I will get into that in a minute, and that also requires some investment. But this investment is always very short investment cycles, and it's very scalable with oil prices. So why we have a very high CapEx figure here in 2023 is because after we had successfully issued our bonds some weeks back, and these oil prices are at the current high levels that we are seeing, we have decided to accelerate some of the development, to increase some of the ownership in some of the development projects that we are partnering in or that we are working at, and therefore harvest and benefit essentially from these high oil prices, therefore high CapEx. But roughly I think 2024 is probably a very interesting year to look at from a revenue, EBITDA, CapEx metric, because that can show you what does a steady state development for Deutsche Rohstoff look like also going into the future. So with roughly 200 million euros of revenue and 150 million euros of EBITDA, if we spend 80 million euros, maybe 90 to 100 million euros of CapEx in a year like that, we will be able to grow our production further, maybe beyond the 12,000 BOE, and obviously we will be north of that in 2024, and continuously grow while at the same time, generate free cash flow here, which we have done in 2022, roughly 70 million euros of free cash flow. So the gap between EBITDA and CapEx roughly represents, free cash flow. And in 2024, you can also already see, based on the current development plan, that there is significant room for additional free cash flow, which makes it very, very attractive to be in the oil and gas space. I think our share price has also shown that recently. We do feel that our valuation is certainly low, and I think compared to our peer group, it is in parts also low if you look at metrics like what is our company value relative to our production profile or relative to our EBITDA. But nonetheless, if you look at the time frame since early 2019, including the dip 2020 in the COVID years and then the recovery after that, depending on the benchmark here, those are total return charts here, so including dividends, you can see that we do have actually performed quite well still, despite the fact that we do see additional upside potential. I will not touch too much on the oil market, but just to give you a very brief overview and our high-level overview, and maybe the view that is not the most popular, but I think it's a reality that the world is continuously going to need more oil. We are at roughly 102 to 103 million barrels of daily oil demand today. I think we are thinking towards 2030, this oil demand is probably going to increase significantly further. OPEC came out yesterday with a new study, and I mean, OPEC obviously is to some extent a biased institution, but they came out with a new study and a new view on the oil market, saying that they expect oil demand to rise to 116 million barrels of oil per day in 2045. So if you look at this chart and just basically pretty much extend this straight line, and ignore the dips for COVID and the financial crisis, it is going to continue to move this way, according to OPEC's view, for another 22 years. And I think that's very significant. And the main and probably key and only reason for that is population growth and hopefully economic and wealth growth in non-fully developed countries. So if you look at this chart here, you can see on the left-hand side, 1 billion people in the world. That includes people in Western countries, the US, Europe, Japan, very developed nations. They roughly consume 15 barrels of oil per year per capita. The other 7 billion people in the world roughly consume 3 barrels of oil per year per capita. So this is roughly a 5-fold increase. But obviously, if there is hopefully economic growth and further development in those parts of the world where 7 billion people live, that very naturally is going to lead to increasing demand for oil. The current demand growth for oil pretty much comes from China and Southeast Asia. Those are the main regions in the world where oil demand growth comes from. Obviously, Europe and further developed countries have rather been on a downwards trajectory, but just the absolute amount of population and potential growth just leads, I think, to our prediction here that oil demand is going to rise for a long time, and also to OPEC's prediction here that oil demand is going to rise and continue to rise for a very long time. I will also give you a quick overview of our US operations and our US business here. So basically, as I said, we're in the US, we're in these 3 states, Wyoming, Utah, and Colorado. A few things on this slide are worth noting. $8.30. That is our operating expense per barrel of oil equivalent. So what does that show you? It's very low OPEX per BOE, right? For every barrel that we produce, we only have $8 of expense. So if oil prices are very high, all right, $80 plus dollars, I mean, this is a BOE, so it's a mix of oil and gas, but if oil prices are very high, this explains basically where these 80% plus EBITDA margins come from. But I will also show you in a few minutes here how you have to think about CapEx and what the economics of one produced barrel of oil are. But obviously in this price environment and anywhere north of $60 oil, the economics of producing oil and gas are very attractive. One other thing to note here that's important, we have 72,000 acres. So that's the area of land that we have leased from landowners on which we can do our development. And only on 6,000 acres that we own, we are currently producing roughly 70% of our volumes. So on 60,000 acres that we have leased, we are only producing a small amount of our volumes. But what that is saying is we do have a lot of running room and there's a lot of potential. A quick, few impressions here. What does our oil and gas development looks like? This is a typical, oil location, a development drilling location in the US. This is how we drill an oil well. When you talk about the oil and gas drilling concept and the fracking of oil and gas wells, really what I mentioned earlier is these very short cycle times. So if we drill one oil well that costs roughly $11 million US, it takes about 4 weeks for a single well. Oftentimes we drill more than one well, from a location. But you can see here this rig is only going to be there for probably 2 weeks. After that, we have the completion and the fracking process. That for a single well also is only going to take a week or a little bit more. And then there is facilities being erected. You can see the facilities here. This is a different location, but we have a nice kind of aerial photo here. This is what, after the 4 weeks of drilling and completion activity, what a location looks like. So you can see there's the oil wells here, there is tanks. And what we are doing is we are producing, from this pad and are selling our oil and our gas directly off of this pad. So it's a very simple and very efficient way of doing business. What we are doing is what's called upstream E&P. So we produce it, but everywhere that's midstream. So basically, once it leaves this pad, the oil and the gas is not owned by us anymore. We have already sold it. Makes it very efficient. You can also see, after 6 to 12 months of production, an oil and gas production site looks more like this. I think that's a good explanation, just visually for why the operating expenses are very low. And as I mentioned, we are in extremely active areas. That competition also drives costs down, drives capital costs down, drives operating expenses down. You can see here, the Powder River Basin in Wyoming, that is really the oil and gas field where we have the largest potential running room going forward for the coming years. It's a huge oil and gas basin with tens of thousands of oil wells. On the left-hand side here, you can see only the horizontal oil and gas wells. So those are the modern completion techniques, the wells that have probably only been drilled in the last 10 to 15 years. There's hundreds and thousands of them. And the little drilling rigs here, those are the currently active drilling rigs. On the left-hand side and the right-hand side is our acreage. So those are the 60,000 acres I pointed to earlier that we are currently developing. We also have a joint venture with Oxy, I mentioned that earlier, which is right between our acreage here. And if you zoom in, you can see still zoomed into our area, essentially, that we are active in drilling wells ourselves and drilling wells together with Oxy as our partner here. There is a lot of activity. All of these oil and gas wells have to be published. That means the production volumes that these oil and gas wells are producing have to be published. They're public. Every single person, on this webcast can take a look at every individual well that we are producing oil and gas from. And this high degree of transparency and this high degree of competition in the US allows us also to know very well what are all the oil and gas wells around us producing. And since we are in what's called unconventional reservoirs here and shale reservoirs that are very homogeneous, there is a very high degree of predictability. So we never drill an oil well that does not produce oil and gas. That is not because we are very smart. That is just because of the nature of these oil and gas reservoirs, essentially the nature of the unconventional development in the US. And this offset production that we can see here, so production from other companies, that we can totally, see how much production is coming, what are the certain characteristics of that production, is helping us also in predicting our own developments. And obviously we have our own development and our own wells that are already producing on our acreage. And as you can see here, there is a lot more to come. So what you can see on this acreage here, we have those roughly 60,000 acres in Wyoming, of which there is, the green wells. Those are wells that are a little bit older that we have actually not drilled, but we bought these wells together with the leases when we acquired all of this acreage here coming out of COVID in 2021 and 2022, which is, by the way, a period that we came out, very strengthened because we had the ability with a strong hedge book and a very disciplined capital management, and I think a strong balance sheet to weather the storm of COVID very well. And coming out of it, used this as an opportunity to grow and make additional acquisitions. And all these gray lines that you can see here, they are potential wells that we can potentially drill over the coming, 5 to 10 to 15 years. Drilling one of these wells roughly costs $11 million. So if we drill 10 of these wells, we are already at 110 million of capex per year. What that means is we are looking at a very large development inventory. And if we were only to develop the acreage that we already have, we have a development running room for the next 10 plus years, to continue our growth, to continue to grow profitably. And as I mentioned earlier, we have also got the ability, because of these short investment cycle times of, 4 weeks for a well, or maybe, 10 to 12 weeks, for 3 wells, to really work with the oil price a little bit. It's not like an offshore investment that we decide on today that takes maybe 2 years or 3 years until it is in production. But, we can, as we have now done last week or 2 weeks ago, if oil prices are high and we are, financially well equipped, we can react to these higher oil prices and are capable of, developing faster and a little bit more. And on the flip side, if oil prices were to crash, we have the ability to relatively quickly halt our developments and, to take cash flow off the table, but to invest less. And all of that is also something that we are hedging. That means we have a very strong hedge book, and our strong hedge book here will allow us, to cover a lot of our production going forward. Our policy roughly is to hedge about 50% of our production, for the coming 12 to 18 months. Currently, we have 1.8 million barrels almost hedged at north of $75. That means if oil prices were to go to zero tomorrow, that hedge book alone would be worth, 120 to 140 million US dollars. So very valuable hedge book. I think that's something that gives us comfort, lets us sleep well at night, and also gives us the ability to calmly and efficiently schedule our future development. I mentioned the CapEx, $11 million CapEx per well is what we are facing here. So a lot of the cost is in the CapEx. And then for an oil well, 6.2 million is what there will be as OpEx over the life of the well. And the life of a well, generally is probably 15 years, maybe 20 years, maybe 25 years. So this OpEx is spread over a very long period of time. You can see here it's roughly $10.65 for this particular, kind of example well, which is probably a conservative kind of well, and $15.60, CapEx per well is something that we are showing here. And then, to take a look at the economics, how economic is it to drill an oil well in the US? So for us and for other oil and gas companies in the US, it's a requirement before we drill an oil and gas well to obviously calculate the returns and to see a return that's significantly north of the range of 15 to 20% IRR. So the IRR, the rate of return here, is what we are looking at mainly in terms of developing the economic, assessment of oil and gas production. 30% IRR in a typical base case Wyoming well that will produce around 500,000 barrels of oil over its life is something that we are using as, kind of our type curve base well. And you can see here, if we drill a well like that costs us, $11 million, what we will generate is around $13 million of free cash flow. So we invest $11 million. Those $11 million will come back over a period of probably 2 years to 3 years, and after that there's still 13.5 million euros of cash flow. And if you look at that from the perspective of an oil barrel, you can see $75 per barrel is what we get, and then there's certain things that come off. So there is the differential for the transport cost, there's the royalties, there's a local production tax, there is the operating expense. And then we have an operating cash flow per barrel of roughly, $49 if we look at it as only oil. And then we do have a net profit after the depletion. That means the CapEx, for every barrel of oil that we have developed, of roughly $27. That could tell you, that $27 is the net profit per barrel that we are producing, coming from $75. You could do the math of 75 minus 27, roughly $48 as a break even here, for the oil price. But some of these factors here are dynamic. So the landowner cost, the 18% that we're paying for landowners, for the leasehold of this acreage, those are things that essentially are dynamic. So the actual cash break even for us is rather at $40, maybe a little bit below $40. On the other hand, in order to make an attractive return, we like the $50 to $60 corridor. And like I said earlier, above $60 US, it's very attractive, and we can meet the return hurdles for future developments here for these individual wells. Obviously, that also scales a little bit with CapEx, and CapEx, again, scales with oil prices. Generally, the higher oil prices are, the more development, the higher the demand for drilling services. And, coming to the end here, just the very last look at what I've also shown in the beginning, where are we headed? Where do we stand? 2023 guidance, 2024 guidance. We have had a significant amount of growth over the last 4 years. We are guiding almost 200 million euros of production revenue potential here in 2023. And in 2024, you can see there's a very good chance, even at $75, that we are going to reach the 200 million euro revenue mark. EBITDA, around 145 to 160 million euros. So very strong potential. If oil was to be at $85, then, we're way north of, guiding way north of 200 million euros of revenue in 2024. And I think that shows really how significant our growth have been, but also how strong we are from a financial side here. And that's something that we want to continue here, and we want to continue to efficiently and in a disciplined way deploy our capital. And we are very happy if you're interested in joining us on that journey. And I think certainly there is potential still here for our stock price to develop. And also, we have always been a loyal dividend-paying entity. We've paid €1.30 dividend this year, which roughly represents, 4.5% to 5% dividend yield, depending on what share price you look at. And we've always been committed to continue to pay dividends also in the future. And I've always said our goal is to pay a rising dividend. And therefore, I'll stop at this point here. And thank you very much for your attention.
Thank you. Great presentation. We already have a few questions in the chat. So the first question is, why don't you pay out a way higher dividend? If you look at the earnings and the cash flow, there's maybe even a chance for €5. Why pay out a conservative dividend?
Well, I mean, I think in general, obviously, the dividend for us has always been an instrument that's very important, and we have always paid out a dividend. Last year, we have paid out €1.30, like I mentioned. I think a €5 dividend certainly would be too high. I think, first of all, we are still, a sizable but growing oil and gas company. So for us, it does make sense to continue our production, our development. I think the more we reach a high plateau of development here and production, it will allow us to continue the growth and also to become more persistent in the free cash flow generation. And I think the notion that just because we have had one very great year 2022 and are now finally in that position where we are very strong and can continue to grow, using that first great year and those coming great years as the initial data point to distribute an extremely aggressive dividend, which I would call, obviously, if we had distributed €5 here, we would be in the 20% range here. I think that would also not help our share price, right? Because I mean, these extremely high dividends, if we could even pay them out, right, then would limit our share price potential here and would obviously be a significant detriment to our potential future growth here. So I think there needs to be a balance between all of these things, and I think a 5% dividend yield is certainly not completely unattractive, and therefore that's from where we want to continue to grow our dividend now into the future.
And how are financing costs impacting the business in the long term?
So basically on the financing cost side, with this bond issue that we have done recently here at 7.5%, we have really cleared the way for financing questions for the next 5 years, right? So we do have a small maturity still remaining out of this bond issue because we are terminating the old bond, and we will then, let's say in 6 to 12 months from now, we will only have one single €100 million bond outstanding. Our next large maturity is then going to happen in 2028, which allows us obviously to have a lot of running room. I think 7.5% is a very competitive coupon in the oil and gas industry, so we are relatively comfortable on that front. And I think the short answer is we feel like we're pretty well set on the financing front and are not subject to a very large risk on the financing cost side at this point.
And what do you think about the investment in the tungsten in South Korea with Almonty Industries? And
yeah, as I mentioned earlier, 10% roughly of our balance sheet is still in the metals and mining space. And those 10% represent roughly 35 to 40 million euros, and the vast majority of that is our shareholder ownership and some loans that we have made to Almonty Industries. So Almonty Industries is a tungsten producing company that we'll be presenting here, I think, later on today. And we have sold from our early days a tungsten mine to them and are a significant shareholder and have always continued to support the development and the business of Almonty. It's a little bit out of the oil and gas side, obviously, other than that a lot of the drill bits in oil and gas are made from tungsten. But we have always kept on to this investment because we think strategically it's a very interesting investment. It's building the largest tungsten mine outside of China currently in South Korea, and it's something that is for us right now an investment that does not lead to immediate cash flows or anything, but from a strategic standpoint, we've always sticked to it and think it's very attractive, even though obviously the mining space never is easy and is a very volatile one. But it's a tremendous job of navigating that and getting close to taking its mine into production.
Excellent. Yes, thank you very much. The time is up.
Thank you. Thank you very much, everybody, for your attention, and I wish you a great rest of the conference.